Hello and welcome, everybody. Happy Friday. Welcome to the end of another week. But before we get to the weekend, we have another Sectors Made Simple webinar for you all. Today, we have a lot to discuss as we had the FOMC meeting from this past week for us to review. And while the outcome of the meeting might not be as bad as the market might want you to think it was, the effects that this meeting had on the market were substantial. And most of those substantial changes were not positive. So today, I want to try and help relieve some of the pain and some of the fears that you might have about, well, are we heading back down the same road that we saw earlier on this summer? Or is the market maybe overreacting a little bit? Somewhere between those two extremes, the real truth lies. And instead of me telling you what you should think about it, my goal today is to provide you all with the same information that I had to make my own decision so that you can make yours as well. So today we're going to review the notes from the FOMC meeting, go over a bit more about what that meeting actually tells us and the numbers they look at for that meeting, the results from that meeting, and then also some different ways that we can look at investing. Now, those ways that we're looking at investing, it's not going to be recommendations. It's not going to be buy this company, don't buy that company. Instead, I want to instead look at a lot more high-level macroeconomic trends. I want to talk about what categories of companies will be doing better or worse, and also, again, try and relieve some of that fear that is dominating the market right now. So it's going to be a lot of information, but hopefully a lot of usable information in today's webinar. So I won't keep you any longer. Let's get straight into the action. So this webinar is going to be all about the September 2022 FOMC meeting, reviewing what came from that and where we go from here. The goals for today's webinar are very, very straightforward. The market was shaped by two major events from this past week. But the biggest one and the most glaring one is the FOMC meeting. So our goal for this webinar is to review that FOMC meeting in a little bit more detail and take away see what we can take away from that meeting. Because again, it's not as terrifying as the market might want you to think it is. So we're going to review what came from that meeting. We're going to talk about the summary of economic projections, which is where the FOMC and the Federal Reserve put their pens, or I guess in this case, their computers where their mouths are, and show us where they think monetary values are headed from here. So we'll take a look at that summary of economic projections, and we also have something to compare it to, because we can compare it to the summary that we looked at back in June when we saw the last FOMC meeting that resulted in one of these summaries. So we're going to take a look and compare now to June and see where they think things are headed, but more importantly, how much has changed in the past 3 months. So let's get into it. A little bit of background before we get into the actual meeting. This week was not a good period for the market, and you probably don't need me to tell you that. By the way, if you're watching this recorded, welcome. Thank you for being here. This webinar was recorded on September 23rd of 2022, and the meeting from the FOMC was the 20th and 21st. So we are looking at things very recently. This is very fresh in our minds, but also in what's going on in the stock market. So if you're watching this recorded, things might have changed a little bit in the economy and in the market, and it'll be interesting to see how reality compares to what we might see on paper. But when I talk about this week, what I'm talking about was the trading week from September 19th to September 23rd. So again, this week in the market was shaped by two major events. The first, and definitely the smaller one, but historically significant, is the come down after triple witching week. In our September market forecast, we talked about triple witching week, this expiration of derivatives that occurs once every quarter that is a very active time for the market, leading up to market close on Friday, which this Friday, the Friday of triple witching week this quarter was September 16th. we saw a lot of trading activity happen up through that. Now, in the week after, the market tends to exhale a little bit. And the week after triple witching is typically a down week for the market, where if we look more at historical trends here, we're going to see that over the past 20 years, the S&P 500 went down 2/3 of the time on Wednesdays, and on the Thursday and Friday after triple witching week, we saw a decrease of 72% of the time the market going down on Thursday, and that number jumps up even more to 3/4 of the time at 76.2% of the time down on Friday. But the magnitude of those drops is historically a lot smaller, not the 5% that we saw this week. So something else was going on, and the FOMC meeting was that really big thing that was also going on. So that's what we're going to focus on today. So this meeting was not unscheduled or was not unexpected. The FOMC meets regularly, and this quarter's meeting, or not just quarter's meeting, this month's meeting was not unlike any other month. It happened on Tuesday and Wednesday, September 20th and 21st, and the topic of conversation is the same thing as it always is, the state of the US economy. Now, we have to keep in mind here, the FOMC thinks about the stock market because the stock market is a very large portion of our economy, but it's not their goal. Their goal isn't to provide more value to shareholders. Their goal is not to provide more stability to the stock market. Their goal is to provide more stability in the long run to the US economy, even if it means a bumpy road in the short term. So when we talk about what the FOMC is doing, they don't care. I mean, obviously, they take into consideration what the stock market is doing, but their goal is not to calm the stock market down. Their goal is to do what they have to get monetary policy and our economic stability back in check. And this meeting was extremely crucial for that, because the outcomes of that meeting doesn't just dictate monetary policy for the coming days, weeks, or months. We're talking literally months or years of policy were discussed and updated this past week. Now, before we can get into the FOMC's meeting, we need to first talk about what the FOMC is, but also we're going to talk about inflation. And the numbers that I will talk about for inflation are going to be very different compared to the numbers that you probably think about for inflation. It's not one is right and one is wrong. It's not one is yes, one is no. They're two correct numbers, but they look at different things. Yes, they're both inflation, but inflation is a very loose term. It's the idea that value of something goes up over time. So I'm going to talk about those two different categories of inflation, and then also how we can break down those categories into two other categories. So it's going to be a lot about inflation and a little bit about what FOMC actually is. So let's get into it by talking about what the FOMC is. The FOMC stands for Federal Open Market Committee and is a branch of the Federal Reserve banking system. This group you've probably heard of as the Fed. I wish that we all got to have a cool little title like that. What are you? I'm the Fed. What are you? I'm the John. If you told anyone that, they'd be like, what are you on about? Anyway, the Fed's job is to monitor the US economy, both from a trade and kind of value standpoint, but also on the back end, a lot of movement of money, straight up money. So their job is to monitor the inflows and outflows of money in the US economy and make tweaks to it when necessary by changing the amount of supply there is of money that can be borrowed, lent, or spent. And in turn, one of the things that they can tweak is interest rates. When you go to the bank because you want to buy a new house or a new car, the interest rate that that bank tells you is due in part, there's some that's due to obvious risks. There's always risks when you're doing consumer or even business loans. But underneath all of that risk, there's a little layer that is the federal funds rate. And that federal funds rate is extremely important when we're talking about how expensive it is to lend and borrow money. But I'm getting a little ahead of myself. Let's go back to what the FOMC is and talk about who the FOMC is. The FOMC is made up of 12 people. 7 are governors of the Federal Reserve, 1 from each one of the districts, and they are nominated by the President of the US and then approved by the US Senate. One of these members, who is currently Jerome Powell, is the chair of the FOMC. Then we have 5 other members. 1 is the president of the New York branch, and then 4 are members from other districts. Now, each one of the groups will have a rotation. So there are 4 groups, each one with 2 different Federal Reserve branches, and they'll rotate out on a 1-year position. Now, when does the FOMC meet? Again, I said before how they don't meet every month, they don't meet every quarter, instead they meet twice a quarter, 8 times a year. And in each of these meetings, the committee reviews the current state of the US economy. They look at things like inflation, GDP growth, unemployment, and also the federal funds rate. More on that later. But at the end of every quarter, their final meeting of the quarter includes what's called the Summary of Economic Projections. It's a lot of statistics. It is very boring if you don't care about numbers, but as investors, it's very important, as US consumers as well, it's a very important piece of information for us to understand and look through. Because these summaries are, again, the representation of these very important policymakers for monetary policy in the US, deciding where they think our direction is headed. Where are we going? What are the different milestones that they think we're going to hit along the way? And again, that's going to be a lot of what we're going to talk about today. We're going to look a lot at this summary because we're coming up to the end of quarter 3, and in this past week's meeting, we did get a new summary of economic projections. So we will be reviewing that, and sadly, it's going to be very numbers heavy, but I'm going to boil it down to, why do you care? What does it tell us? Why do you care? And how do we use the information? I think that will be a little bit more interesting than looking at a bunch of charts and box and whisker plots. But again, getting a little ahead of myself. Sorry, I get so excited about data. Anyway, what can the FOMC actually do? What power do they have? Well, a lot. They have 3 main things that they can do. The first is the discount rate. This is the rate at which the Federal Reserve lends to banks. Then they can change reserve requirements, which is how much money banks need to keep in their reserves. Banks always are required to have a certain amount of funds available. That is how they decide that. But the big one is open market operations. They can buy and sell US Treasury securities to banks. And these OMOs, as they're called, are extremely important because this is the way that they impact the federal funds rate the most. Now, I keep saying more on this later, tonight at your nightly 9 p.m. news. Anyway, what is the federal funds rate? Let's get to that, all right? So the discount rate is simply the rate that the Fed lends to other banks. But the federal funds rate is the rate at which banks lend to other banks, which is a lot of how overnight loans actually work. Banks lend to banks very, very frequently, and to the tune of billions of dollars. It's not because Bank of America is rich and Chase is broke. It's the normal flow of monetary policies. This is something that is very, very common. This rate is, there's always a target of what it's supposed to be, but the real rate can vary about 0.25%. So when you look at the rate, you're going to probably see 3% to 3.25%. It's always a range of 0.25%. One is the rate at which the lending happens. One is the rate that the borrowing happens through the Federal Reserve. So now that we know a bit more about what the federal funds rate is, why does it matter? How do we use the federal funds, or rather, how does the federal funds rate use us? Let's be honest, we don't get to use this. It uses us. Anyway, let's think about how this federal funds rate would actually work. Let's bring it down to reality. If it's more expensive for Chase to borrow from Bank of America, then it's going to be more expensive for Bank of America to loan to you. Remember how before I was talking about there's that normal consumer risk level, usually around 2.7 to 3.3%? That is the range that if the federal funds rate was 0, you would be able to get for a normal fixed rate loan. The federal funds rate it's the booster chair. It is a flat amount that sits underneath that rate. And as the rate goes up, again, it's not going to always stay at 2.7 to 3.3%. That's if the federal funds rate is 0. That's what you might expect to see. And that's what we were seeing back in 2020. But as the rate goes up, there is more risk in consumer loans or in company loans. But really, this federal funds rate starts off our number higher. Instead of starting at 0% and then adding on whatever other risk evaluations they do, it's going to start at 2% or 3%. And then they'll tack on everything else. So if you went and you looked for like a 30-year fixed mortgage rate, let's just do this together really quick, out of curiosity. What we would see here is right now the rate is sitting around 7.1%. This number, just about 2 years ago, was 2.8%. So we've seen the number triple in the past 2 years, mostly due to the federal funds rate going from 0% to over 3%. Because when borrowing money becomes more expensive, then loans are going to be more expensive. And that might seem like a bad thing, because it is, but it's the goal. The goal is to cause pressure. The goal is to change what's happening, because what's happening right now is inflation's crazy. You don't need me to tell you that the price of everything is skyrocketing, and it's not sustainable. Inflation is good, and we'll talk about that in a moment. But too much inflation is not. It starts to put a lot of pressure on things like, salaries. The fact that your salary does not scale as much as inflation does. So if you aren't making more and everything costs more, your buying power goes down. That's not good. So the federal funds rate is the way that the Federal Reserve can try and boost how expensive it is to borrow money. So when it's more expensive to borrow money, expansion and development goes down, spending goes down, inflation goes down. And that's the goal of the federal funds rate. They'll hike up the federal funds rate to try and lower spending, lower borrowing, make borrowing more expensive so less people are borrowing, and thus contract the economy a little bit, bring inflation back under control. I've talked a lot about inflation, inflation, inflation. But there are 4 different inflation numbers that you might see in here, and I want to talk about the differences and why each one of them is important. There's one that's not very important, but I'll mention that when we get to it. So first, what is inflation? It's not what happens when you go to the carnival and someone has a big can of helium and is putting a balloon on top and it goes whoosh. That's a different kind of inflation, one that we're not going to talk about today. Instead, inflation is an economic principle that means the value of money goes down over time. Or rather, how much things cost goes up over time. The prices of things inflates, hence the name. Bringing it down, things get more expensive. Thank you for joining us today. It's been a pleasure. No, I'm kidding. Things becoming more expensive might seem like a really bad thing. I just talked about how in an extreme case, if wages aren't going up, but the cost of gas and food is, that's not a good thing. So why am I saying now that inflation is a good thing? Sometimes. Well, it's because everything in moderation is usually not bad. And in this case, is healthy. This can be our glass of wine at the end of the night. Inflation is a good thing for the economy because if you know your money is going to be worth more today than it will be tomorrow, if you have a $5 bill in your pocket and you know that that $5 bill will buy you more today than it will tomorrow, then you're more likely to spend that $5 today. I always go back to this Chipotle index idea that I have of, I remember when I used to go to Chipotle and I could get a steak burrito with guacamole for like $10. I went to Chipotle yesterday, not a sponsor by the way. Chipotle, if you want to sponsor me, email's down in the description. My burrito cost me $13. I missed my $10 burrito with guacamole. Now I'm paying $13 and no guac. This is an extreme example. This is a goofy example, but it's honest. The fact of the matter is the price of my Chipotle burrito has gone up, but so has the price of gas, of rent, of anything. Everything, the price is going up. Now, when it comes to inflation, there are 2 main categories of inflation that are used: CPI and PCE. They both are inflation. They are both correct. One is not right, one is not wrong, but they are 2 different things. Let's talk about that. First, CPI, because if there's going to be one of the 2 that you know, this is going to be that one. You will know CPI. CPI stands for Consumer Price Index. It is data that is sourced by the Bureau of Labor Statistics for consumers. It is sourced from consumers. There are 2 main types of CPI, CPI-U and CPI-W. W is not really used. It only represents about 7% of the US population. So we look instead at the other 93%, which is going to be coming from that CPI-U calculation, which covers urban households. So whenever you see CPI, it's usually 93% of the time probably going to be, by the way, not an actual statistic. Most of the time it's going to be that CPI-U, that urban household index. So what this number actually looks at is it looks at the change in prices of things like food, energy, transportation, housing, materials. It is a very, very comprehensive number of all of the things that a US consumer in an urban environment spends their money on. When you see a news source, Bloomberg, MSNBC, I don't care, any of them, they're probably going to be looking at CPI. This is easily the most common that is looked at. But one group that does not look at CPI is the Fed. The FOMC does not report on CPI. They do report on inflation, but they don't report on CPI. Because instead, they choose to report on PCE. So let's go talk about that now. PCE stands for Personal Consumption Expenditures. I liked Consumer Price Index more. Easier to say. But it's a slightly different sourced piece of information. Instead of being sourced from urban consumers, it's sourced instead from businesses and GDP metrics. This includes both urban and rural households, but also includes other things such as nonprofits. Romulo is asking, raising the interest rates is the only way to control inflation. It is not the only way, but it is the most impactful way. Again, when it comes to the Fed has multiple tools for them to use. So they can use the lending rates, and they can change how much money is available to US banks, but also change the rate at which banks lend to other banks. So it's supply and demand, but also the interest rates. So they can do more than just raise the federal funds rate. So now, for PCE, it's from businesses and GDP, so production of companies, includes urban and rural households because they don't care who they're selling to, they just care that it's being sold, and also includes nonprofits. Now, the media and individuals typically do not look at PCE. The main group that looks at PCE is the FOMC. So many acronyms in this webinar. Part of the reason why they choose to look at PCE is a long one to get into, but to summarize it very quickly and succinct, PCE is lower volatility. It tries to account for seasonal changes. It tries to be a more long-term indicator of inflation. And due to it being a more long-term indicator of inflation, is typically more stable, less volatile, and when it comes to dictating US economic policy, that stability is something that the FOMC values. So this is why PCE inflation is looked at for the FOMC. And when we review the summary of economic projections, you will not see CPI. Instead, you will see the PCE inflation rate. But you will see one other thing: core inflation. Core inflation applies to both PCE and CPI. But we need to know the difference, because there is core inflation and then there is headline inflation. I'll give you a guess at which one you will see in the headlines of different news articles. Spoiler alert, it's not core. Headline inflation is the number you're going to see in reports. It's going to be that number that is most commonly referenced by news articles and by individuals. When you ask someone, do you know what the rate of inflation in the United States is? They're going to probably just tell you the headline CPI. And there's nothing wrong with that. That is the most accurate indicator of urban consumer price changes. This headline CPI is a more, not accurate is a good word for it, but the more descriptive word for it is a more well-rounded indicator, because it includes things that you probably spend a lot of money on: energy, food, being the two biggest categories. They are categories that the prices change very quickly. And they change very quickly, not only in terms of overall magnitude, but also they change a lot with cycle. They change a lot with season. So they are typically much more volatile categories. Inflation core inflation tries to minimize some of that volatility by getting rid of home food consumption. So going to a restaurant still counts for core inflation. Buying ingredients to cook at home does not. And they try and remove energy prices from the inflation number to get a, again, more stable view of what the cost that we are spending on living really is. I want to now turn our eyes towards the core inflation metrics that we are talking about. And again, we'll see some differences here. Here's core CPI. For core CPI, we see that inflation has actually gone up quite a bit in the past month, going from 5.9 to 6.3%, an increase of 0.4% in August. But this still is dwarfed by the 6.5% that we saw back in March of this year. Now, let's turn our eyes to PCE and see the differences. For PCE, we do not see that increase in price. Instead, we see a decrease here, going from a high in February, not March this time, of 5.3% down to 4.6% in July. We do not yet have the August numbers. I believe we get those on, I need to check the release calendar. If you are curious, release calendar is in the resources section of this video. I believe it is September 30th. We're going to get that publication. But we are seeing a decrease here, a decreased trend in core PCE. But why the difference? Well, I want to show you something. All items, we see an inflation number around 8%. Food is above 10%. Energy, around 23% inflation. That is why the core rate is going to be so different than the numbers that you'll see for the headline CPI. If you look at headline CPI right now, it's 8.6%. 8.6 or 8.5, one of those two. Compare that, though, to the 6.3% that we're seeing for core CPI. Right now, it is very clear that the two areas of our economy that are suffering the most are the prices of food and energy, two very important things to our sustainability. But these are numbers. Why does any of this matter? Why am I now talking about 4 different inflation numbers? Because I want you to know that when you see inflation and it is not the same number that you see discussed in this webinar, it's not that it's right or wrong. They're all just different things. If you asked Juan de los Palotes down the street what they think of inflation, they're probably going to be more concerned not with the price of their services. They're going to be concerned about food and gas. They're going to be concerned about the fact that gas is over $5 a gallon, in many places $6 a gallon. They're going to be concerned about the fact that their groceries are costing them 15% more than it was before, and they're going to be very concerned that their wages are not going up to match that amount. So consumers are going to care about the whole picture. They are going to care most likely if you gave them all 4 of the numbers and said, which one matters the most to you? They're probably going to point to the headline CPI. Go figure, that's the one that everyone talks about. It's because it is the most well-rounded and the most accurate to where we are today in the short term. But core inflation does not care about that. Core inflation only cares about everything else that is not energy and food costs. So I didn't want to just give you the PCE numbers. I didn't want to just say, well, core is different than headline. I wanted to give you the entire story because, again, when you see a news article mentioning the consumer price index, it's not the same thing as PCE. And when you see them saying headline, or they're not even going to say headline inflation. They're just going to say inflation. They are talking about the headline inflation, which is inclusive of those energy and food costs, for good reason. It is, again, the one that consumers, you, me, and Juan de los Barotes probably care about. But now, let's move away from consumers, let's move to the Fed, and let's go talk about the summary of economic projections. This is going to be where we're going to spend the rest of our webinar. We're going to be looking at these numbers. And I promise, if numbers are spooky to you, that's fine. October's coming up. We can deal with a little bit of spooky, but we're not going to deal with it too much. So we will look at the numbers, but instead of just talking about what the numbers are or showing you a bunch of statistics charts, instead, we're going to cover a little bit more than that. So we will go through what's called the central tendency of all of the different values. But instead of just talking about what they are, we're also going to talk about why they matter to us. So what we'll do is, by the way, the central tendency is we have a lot of different people in the FOMC. They will all have different opinions. So we try and get rid of what are called the outliers. The people that are way too much of a hawk, way too much of a dove. These people that are, we want the middle ground. We want to know where is the chunk of people. If we think about it like a burger, we want to get rid of the bun, the top bun. We want to get rid of the bottom bun. All we want is the filling on the inside. So that's what we'll look at. We'll get rid of the 3 highest and the 3 lowest estimates. And instead, we'll just look at the stuff in the middle. Just the meat, grilled onions, and cheese, the way I like my In-N-Out burger. We'll look at how these central tendencies have changed from the June summary of economic projections to September. And we'll also look at where the forecasts are lying for 2022, 2023, 2024, and 2025. If you are interested in playing along at home, great, have fun. In the description of this webinar, the link to the summary of economic projections that I will be referencing is there. So feel free to play along at home, or after this webinar, feel free to review it as well. It is a very interesting read if numbers and economics data is your thing. If it's not, bear with me. I promise you I will make it easy to understand, and more importantly, I'll just straight up tell you why that number matters and how we can use it. Sorry, just curious, who's got benefits from higher interest rates? Obviously not the consumer. Nobody, and that's the point. The point of higher interest rates is that it shakes things up a little bit. It is taking that bottle of Coke and shaking it up before you hand it to someone. Let's think about the cycle. Consumers, they're a small market. We're going to look instead at businesses. A business probably has loans. If their loans, the amount that it costs to borrow money goes up, their costs are going to go up. When the costs go up for the business, they're going to have to do 2 things. Increase the cost of their products, but that's hard. We'll get to in a second why. Or cut back their spending. They're probably going to cut back spending because that's the easiest one to do. Easiest way to cut back spending, lay off people. They're going to lay off people, which is going to lead to higher unemployment, which also decreases the ability for people to spend money because they're either not getting raises or just straight up getting fired from their jobs, both of which are horrible outcomes. But the result is that those employees aren't spending money anymore, or they're not spending as much money. So when they're not spending as much money, how much money is going to companies is going to go down. When the companies are making less money and they're still needing to borrow money, they're going to have to cut back spending, increase costs. They're going to cut back spending, lay off more people, more laid off people, or wages not going up leads to lower spending. And it's this whole cycle. And that's the point. The point is for some of that cycle to occur without having it just be rolling down the hill at full speed out of control. The point is to have this process be controlled and to make changes when necessary to make sure that it's still under control. Have things slide down the hill a little bit, some rocks get knocked loose, but the goal is at the end of it that we are in a better position. Inflation is lower. Our ability to grow from there is improved. And it is not very pleasant, but it is necessary. Recessions are not necessary. Economic pullback is. And a recession is a type of economic pullback. It's you know me. It is you know. What mic is that? It's got to be an add-on because it does not come with that headset because I have the same headset. Great headset, by the way. I've had this thing for 8 years. Works great. The mic is a Antlion Mod Mic Wireless. I love it. The battery life on it's terrible because I've used it so much. But as you can see, I have my little cable that I can unplug or plug in, and it's fantastic. They come with little magnetic attachments that you can just stick onto the side of your headphones. So that's what that is. Yeah, thanks for stopping in, and thanks for the question. Cool. So now that we've covered all of this, let's go now and look at the actual summary and review how these numbers have changed since June. We're going to start off here with the change in real GDP. For the change in real GDP, the June central tendency was a range of 1.5 to 1.9%. What that means is if we took the highest two numbers, so things above 1.9% and got rid of 3, the things below 1.5 and got rid of 3, everyone else is between 1.5, or I guess on this side, 1.5 and 1.9%. September has gone down sharply to 0.1 to 0.3%. Positive change in GDP. The forecast for 2023 will see a 0.5 to 1.5%. 2024, uptick from 0.5 to 1.5 over to 1.4 to 2%. And then probably going to see it leveling out around that point. Now, why does this actually matter? Well, from a very surface level standpoint, US make more things, US strong economy. It's kind of what it boils down to. But really, from an economist standpoint, GDP is one of the most commonly referenced metrics when we evaluate economic health or recessions. When we see these recessions occur, it's oftentimes coupled with negative GDP changes, and a definition of a recession is a period of 2 consecutive quarters of GDP losses. So seeing September's GDP, oh, thank you very much for that help. Seeing GDP numbers going down is a bad sign. That means that a recession is looming or is already here. Earlier this year, we did see a negative quarter of GDP, but pretty soon after, we saw a recovery. So what this number is telling us is that the Fed does not see GDP dropping. They see it slowing, or if not slowing, stagnating, but not receding. That is a very positive indicator. That is a sign that the Fed feels that we have gotten close to, if not gotten to our goal. Now, despite these estimates dropping, again, the fact that we are seeing growth already and that the Fed predicts this growth to continue is a very positive sign. Now, unemployment. This is the big one. So unemployment, the June central tendency was pretty solidly around 3.6 to 3.8%. September's central tendency is an uptick to 3.8 to 3.9% for 2022. The 2023 forecast is going to be 4.1 to 4.5%. 2024 is 4.0 to 4.6%, and 2025 stabilized at that same rate, around 4 to 4.5%. Now, this one is the one that I'm personally watching the closest, because one of the largest things that is a result of economic pullback, and one of the biggest that impacts us, is unemployment. When companies start cutting back on their spending and on their expenses, they're going to lay people off. And the fact that this unemployment rate is, again, their estimate has not changed much. Their estimate is 3.6, went from 3.6 to 3.8, up to 3.8 to 3.9. Also, if we look at how closely the Fed gets these numbers right, there are two things that they are very, very, very good at estimating. Of course, the federal funds rate, but also unemployment. They are pretty confident when they report on unemployment that their numbers are going to be close to, if not correct. So the fact that we are seeing only a minor uptick, despite much more aggressive policies, which we'll see later in the federal funds rate, and a drop in their estimates, not in a negative GDP, but a pullback in their GDP estimates, the fact that unemployment is not skyrocketing is a really positive sign. That means that the Fed thinks that we can avoid full-on recessions and what negative economic events come with recessions. One of the most important being unemployment. The lowest, and by lowest I mean the smallest, unemployment rate that we have seen in a recession in the past 70 years was 5.5% in 2001 as a result of the dot-com bubble. Every single one of these estimates falls well below that 5.5% line. Also, they fall below 5%. So this, to me, is the point where I realized, wait a second, I think the market might be overreacting. This number they are pretty good at predicting. If the Fed does not see a out-of-control spike in unemployment, if they feel confident that unemployment will remain around this 4 to 4.5% line, that's a reassuring thing to me. Again, 0% unemployment is unrealistic, and that does not happen. The Fed accepts a certain level of unemployment as normal. All of this is on the higher end of normal, but is not cause for concern, and it is still well below any unemployment numbers that we have seen in a recessionary period. Now, let's put all of that information that we learned about inflation to good work. June's central tendency for PCE inflation, by the way, headline inflation here, 5.3 to 5.7%. September's estimates have lowered to 5 to 5.3%, with 2023's forecast dropping almost by half, down to 2.6 to 3.5%, lowering again in 2024 to 2.1 to 2.6, all the way down to 2 to 2.2 by 2025. Why does this matter? Obvious. Inflation. This is inclusive of energy and food, which right now are crippling many U.S. consumers. So a sharp decline in this metric at no cost or minimal cost to unemployment is a great sign. That is something that is the silver lining in this report, is that they think we're going to slash inflation by 50% in the next year. That is a very optimistic report. But right now, I think we don't need more pessimism. I think a little optimism is not the worst thing. But let's see. I feel like this time it's different. I see now hiring signs everywhere I go. COVID changed the game. Is that why unemployment has not risen at a much rapid pace? Great question. That has been actually amazing question. That has been an ongoing oddity since COVID. COVID saw a huge spike in unemployment. And in fact, right now, we are close to the lowest unemployment we've had since the beginning of COVID. Now, last year around this time, we actually talked about unemployment and how there is actually more jobs available than there are unemployed people. And the real issue does not stem from the fact that people don't want to work. The incentives to stay at home and not work are gone. There's no incentives anymore. From a worker's standpoint, they're working way too long for way too little pay and way too little benefits. That is the reason we're seeing a lot of low rates of unemployment, but also a lot of hiring signs, is the fact that a lot of people don't want to take the jobs that are available because they're not getting treated the way that they would want to be treated. They're getting overworked and are underpaid and aren't getting enough benefits to justify that loss of quality of life. So did COVID change the game? I don't think it changed the game. I think that this is the result of companies preferring profits over the goodness of humans. Beyond that, it's really hard to say. But there's definitely an imbalance between jobless and jobs. And there's a reason that we are still seeing so many hiring signs and so many companies saying, well, we can't find enough workers. Because a lot of the approach, because they can't really increase costs very much, or increase the prices of things, is to lower their spending, cut back on employees, have the employees that they already have work more hours. Great question. Really interesting topic. Now, let's move away from energy and food costs and look now at core PCE inflation. I'm going to go through this one a little bit faster. We already know what this is. We're going to see an uptick in their estimates from 4.2 to 4.5 over to 4.4 to 4.6. Again, with a slash this time of about 1/3, moving back down to that 2 to 2.2%, just in line with the normal PCE. The part that matters here is not the numbers, it's the fact that what we're seeing is the forecasted core PCE is lower than the headline PCE. This is a sign that the Fed thinks that prices for food and energy costs will stabilize in the next year. And that, again, is a very optimistic sign. Now, moving into the big topic here, because this is the one the Fed can actually control with a snap of their fingers, the federal funds rate. In June, we saw their estimates for the end of 2022's federal funds rate with a central tendency of 3.1 to 3.6%. It is now increased to 4.1 to 4.4%, an increase of almost 33%. Then we see that number ticks slightly higher to 4.4 to 4.9 in 2023, 3.4 to 4.4 in 2024, and dropping 1 full point again down to 2.4 to 3.4 in 2005. And why does this matter? Obvious. The federal funds rate is the Fed's most effective and most immediate tool to combat inflation. While we do see that September's central tendency is 33% higher than June's central tendency, we should get used to that. We will continue to see sharp increases to the federal funds rate through the beginning of 2023. But again, if a lot of this comes down to at what cost, if the Fed doesn't think inflation is going to be that cost, then we have to question what is. Something's got to give. And from what this is showing, it doesn't seem like inflation is going to be the thing to give. And honestly, I don't have an answer for what will be. All I know is that the Fed's going to continue aggressively changing this federal funds rate, probably through the beginning, if not mid, of next year. So get used to seeing the headline of FOMC meeting ends in 0.75% increase to the federal funds rate. Now, Let's turn our eyes to the federal funds rate once again. Because again, prior to this meeting, the actual federal funds rate sat at 2.25 to 2.5%, and with Wednesday's update is now at 3 to 3.25%. The market did not like this. The S&P 500 ETF SPY dropped by about 2.7% in 1 day. Sorry, 1 hour. Dropped in 1 hour. And by the end of the week, which was 2 days and 1 hour, we saw SPY drop 5.1%, with small cap companies getting hit even harder. So where do we actually go from here? Well, let's break it out into short, mid, and long term. Short term, it's impossible to say. All right, if someone tells you that they know where the market's going to head from here, don't believe them. If someone says crypto's the answer, don't believe them. There is no single person that can confidently tell you where the bull market will be and how you can make money through this. The real answer here is uncertainty is the only certainty. And it's tough. But what we've seen is there's been pullback in every single sector of the market. And while small cap companies have been hit even harder than large cap, no one's been immune. As it stands, the S&P 500's BPI is on the edge of being oversold around 33%, while 5 of the 11 New York Stock Exchange sectors sit in oversold territory as well. That means there's a lot of room for opportunity and recovery. When this growth will begin, though, is a different story entirely. But what can we actually do then? Well, going beyond just short term, let's instead now go from days to weeks to months. Value will be king. The fact of the matter is, there are large, massive companies that have been around for 20 and 30 years. They have weathered every recession in the past, and they will weather this market pullback as well. So value will become king and is king. So as we start to see recovery, it's going to be really clear that the direction of monetary policy right now is going to keep getting hotter and hotter over the next year. So what we're going to see is company growth continue to slow down, especially for companies that a lot of their stock value is based on that growth. When their growth numbers from their earnings slow down, the valuation of that company is going to slow down. So instead of going for the companies whose stock price is based on their prospective value, instead we should turn our focus towards companies that are value companies. The stock price is not based off of its prospective future value, it's based off of its real value today, or the value and stability that it provides to investors. So these defensive companies, these large kind of giants of the stock market, are going to be our kind of first go-to when we try and consider what do we invest in. These value companies, especially ones that pay high dividends, those dividends will offset short losses. Arnulfo, you believe the Fed will increase the interest rate again? There's no way they're going to stop increasing the interest rate at least for 5 to 6 months. Yeah, we're going to continue to see 0.75% increases. Yeah, their goal by the end of the year is 4.1 to 4.4%. They got some room to go. So yeah, we're going to continue seeing that number going up. But for investors, again, value companies have weathered every up and down in the market. That is going to be where we can turn our focus and look for opportunities for investing. If the company isn't immediately making short-term profits, dividends are a great tie-over that will provide us with some income from these companies or an offset to losses if we are seeing companies continue to slide. And especially in the midterm, something that we'll be looking at is in late October, early November, the beginning of quarter 3 2022 earnings reports. Now, long term is where things get a little hazy. But what I can say is that bull markets begin in market pullback and recessions. And regardless of the severity of this pullback, whether it's a pullback or it is classified as a recession, bull markets begin during this pullback. So the Fed is pretty well in agreement that GDP will either stagnate or slightly tick up in 2022. And that's a positive indicator that a full economic crisis can be averted, that we're not going to see massive GDP losses as we've seen in past recessions. And when we're thinking about things in the long run, if there are minimal changes to unemployment, we will see a market recovery beginning. Now, in that market recovery, the first sectors that will begin to thrive, the ones that will serve the most in a beginning of a bull market, will be the sensitive sectors such as technology, discretionary, and communications services. So keep an eye on those. Hi, Jonathan. How do you see October? Great question. Next Friday's webinar is my October market forecast. So I will have an entire hour worth of answers for you in that webinar. So I hope to see you there. And last thing, how can I stay informed? I've talked a lot today, and I don't blame you if some of this was a little crazy and you want to be able to follow this on a more ongoing basis. Well, over on sectorsmadesimple.com, we offer a subscription, which is access to all of our members' webinars, over 100 hours of content for you, but also our dashboard, which looks at sector relative strength today. So here, we'll be able to track not only what sectors currently hold leadership, where right now we see defensive sectors, utilities, staples, and healthcare holding leadership, but also changes in momentum, and I believe it's going to ask me to, oh, it's not cool. And also BPI for the entire New York Stock Exchange. If you want to know when these markets begin to recover and companies start to go on buy signals, this will give you a pretty good inclination of that. Combined with our spreadsheet resources, you can find buy signals in companies and sectors that are just starting to turn around. And when we're seeing many sectors currently being oversold, that's a lot of room for opportunity and growth. So the matrix is a great place to keep an eye on what sectors are leaders today. Sector BPIs will highlight different sectors that are beginning to see that reversal occur. And as we move into the fall, I will continue to have all of these monthly forecasts to give you my insights as to what I'm keeping an eye on in the upcoming month. So tune in next Friday, where I will talk once again about where I see things headed in October, key dates, and key economic indicators that we can keep an eye on. If you want to follow along with all this data yourself, Fred, which is a data branch of the St. Louis Federal Reserve, they have a release calendar on when different economic pieces of information are published. Again, that link is down in the resources section of this video. But unfortunately, that is all the time we have for today. Carmen's asking, Jonathan, which index do you think will start to increase first? Great question. Typically, small cap companies are the first ones to recover, but they're also the ones that are hit the hardest. So if we compare the S&P 500 to something like the Russell 2000, we would see that in the past 5 days, the S&P was down 5.1%. The Russell 2000 was down 7.3%. So small cap companies will be the first to turn around and we'll see the largest recovery, but it's tough to say because you never know where the bottom is. I'm hoping that the bottom is not very far. If not, we've already bounced off of the bottom because the worst news is already behind us. Now I'm hoping that more content like this webinar comes out to try and take some of that fear away, to go back to the numbers and look at why the market might be the market always overreacts, positive or negative. That is why things like bullish triangles are such a common chart pattern. It is the market trying to find the new fair value of things. Right now, the way I see it, the market reacted way too severely for the news that we got. Reading through the summary of economic projections and giving you all this webinar hopefully has provided you a little bit more confidence in understanding that things aren't as bad as the market might want you to think they are. So, on that, thank you all for joining us. If you want to hear more about my insights and analyses of the market and where I think things are headed for October, please tune into our webinar next week. If you enjoyed the webinar and you're still here after an hour of me talking, please give the video a thumbs up. It is free and it really does help us with the algorithm. So thank you all so much. Have a great weekend and we'll see you all very soon.